Good evening. You're tuned into Business Day right here on ET Now with me, Avan Dabash. Let's get in a check as to how the markets panned out this Tuesday before we take you through the top headlines. Well, a very volatile day of trade, but we were largely in a very tight range. There was a positive reaction to the 25 bips cut in repo and CRR cut. We soared above 6100, but then there was a sell-off with most of your rate sensitives coming off by the end of the day. A very weak market breadth, and by the end of the day, the Nifty was at 6,049. The Sensex shutting shop below 20,000 at 19,990. Well, lots of big stories, including the monetary policy, as well as individual result reactions. We get you all that and more after the headlines. The RBI cuts the benchmark interest rates and cash reserve ratio by 25 basis points. But the governor says further easing will depend on the government's success in taming the current account deficit and curbing inflationary trends. Home and car loans may become cheaper as banks will be forced to pass on the benefits of lower costs and higher liquidity. HDFC's Keki Mystery says they will reduce home loan rates. Markets react positively to the rate cut but shed all the gains in the last hour of trade to end down by 0.5%. Banks, real estate and auto stocks, which had gained in anticipation of a rate cut, tank on profit booking. Real estate is the worst performer for the day. ETIHAD Airlines top team led by CEO James Hogan is arriving in India to seal the stake deal with Jet Airways. The four-member team will meet Aviation Minister Ajit Singh and Commerce Minister Anand Sharma to appraise them of the deal structure. Those were your top headlines at 4. Let's take it straight to the big story for today. And the Reserve Bank of India cuts the repo and the repo rate for the first time in 9 months by 25 basis points and surprised the street with an equal cut in the cash reserve ratio, which is going to infuse 18,000 crore rupees into the banking system. The RBI does see inflation cooling off and has cut its March forecast to 6.8% versus the earlier 7.5%. The growth projection for the current fiscal has been cut to 5.5% from 5.8% earlier. Governor D. Subbarao has struck a cautious note saying further easing will depend on the government's success in taming the current account deficit and curbing inflationary trends.
We are into relentless pursuit of higher growth and lower inflation. And in that pursuit, we reduced the repo rate this morning. We did both actions, both the rate action as well as the CRR action, in order to ensure that there is transmission of monetary policy into lending rates. The momentum of inflation, the 3-month seasonally adjusted moving average annualized inflation, that also shows that the momentum of inflation is coming down. There was a structural liquidity deficit, and that prompted the CRR decision in addition to the rate action. Our expectation is that growth has bottomed out. The biggest risk for inflation and for macroeconomic management is the current account deficit. Not just a high current account deficit, but a high current account deficit in the context of slowing growth and high fiscal deficit. If inflation eases further I mean more than we expect it to, and if CAD moderates further, by further I mean more than we expect it to, because in the fourth quarter CAD might be less than in the third quarter, but it has to be significantly less, and we have to have low and sustainable CAD. So if inflation moderates further, CAD moderates further, there will be more room for monetary policy easing.
Let's get in our banking editor, George Cherian, to make more of the Reserve Bank of India's move. George.
It is very possible that you may see an additional 100 basis point cut going forward. Now, yes, there are some bankers who are actually expecting rate cuts to that extent. But like the RBI said yesterday in its macroeconomic review, that any action that must come from by way of monetary policy from the Reserve Bank of India will come only on the back of what's done by the center. So if you saw a 0.25 percentage point cut today, it ought to be viewed as a response to action taken by the government in January when, railway fares were addressed hikes tinkered with, even if only marginally. The fact that gold imports, the import duty on that was raised by 50%, the fact that diesel prices were partially decontrolled, and also expenditure curtailment is on in full swing. You're seeing action on the part of the government on the fiscal front, and you are seeing the RBI respond to that. So any further action from the Reserve Bank of India will hinge entirely on action on the part of the centre. So if you see the centre doing nothing at all from here on, expect no rate cuts. That's the clear message coming from the Reserve Bank of India. If the centre progresses going forward with action on the fiscal front, addressing issues on the supply side as far as inflation goes, addressing issues on the current account deficit, the fiscal deficit, all of these factors, if they continue to be addressed over the next few months, you can be sure that the rate cuts will come. Who knows, it could be 100 basis points, it could well be even more than that. But everything, from any sort of action on the monetary policy front will be entirely the outcome of what happens at the central level.
Okay, that's what we can expect in terms of the road ahead. Thanks very much, George, for putting that into perspective. Meantime, Montek Singh believes that the RBI's decision is widely welcomed and that the CRR cut is the right thing to do at this point in time, as economic growth has bottomed out and the government is taking steps to revive investments.
Obviously, the decline in the CRR will be welcomed by markets, because it essentially will create more available resources for the banks to lend. I think that's the right thing to do at this point, given that we feel that the economy is beginning to bottom out, and that we hope that many of the steps that the government has taken will lead to a revival of interest in investment and faster movement of some of the big infrastructure projects. The decline in the repo rate is also welcome as a signal. I mean, of course, the really important thing is what happens to the long-term interest rate. We need to move to a growth-supporting policy, since the macroeconomic worries are now a little bit better controlled, and I think the RBI has endorsed that view.
Bankers too welcome the Reserve Bank's move to cut rates, but they believe that lending rates will ease first, followed by a cut in deposit rates.
Today the banks are loaded with handicaps. Our interest is taxed at the highest marginal rate, whereas the mutual fund investments, even in the debt funds, are taxed at a very benign rate of 10%. They have a better liquidity arrangement. So all this taking into account, and the deposit rate, of course, each bank will have to assess that what is their requirement of the liquidity, and would price their deposits accordingly.
I think in the current situation, we have to understand that deposits are growing at a rate lower than credit rates. On the lending side, there is going to be a transmission. On the deposit side, we are going to watch the situations. There will be a positive impact on EMIs, clearly.
We've had both a CRR cut and a repo rate cut. There will be monetary transmission. We've always said our margins, since it depends upon the macro environment, always remain in a range. So do we see a slight pressure on margin? Not really.
The Reserve Bank has indicated a reduction of 25 basis points on the policy rates and another 25 basis point reduction on the CRR. It's a very welcome move from the Reserve Bank. If you look at the outlook that is given, the outlook has brought growth over inflation. There are pressures on the NIMs because we have seen that there is last time we talked about a 75 basis point increase in restructured advances provisioning.
Meantime, interest on home loans may slide lower in the next 3 to 4 weeks. K.K. Mistry, Vice Chairman and CEO of HDFC, the country's largest mortgage lender, tells ET Now exclusively that it may pass on the benefit of the rate cut to consumers.
The CRR cut will immediately translate into a lower amount of borrowings by banks and therefore reduce their costs straight away. We could probably look at another 0.25% cut in March. Over the next 1 month or so, one would start seeing the impact of lower interest rates in the system, maybe even earlier than that, maybe the next couple of weeks.
Economists, meanwhile, believe that the fiscal deficit will return to reasonable levels, and they expect a 25 to 50 basis points rate cut by the month of March.
Over a period of time, we would see the fiscal deficit returning to much more reasonable levels, so yes, I think positive, the whole environment is positive, both on the fiscal front and the monetary front.
He's emphasized the stickiness of inflation.
he's emphasized the structural nature of the current account deficit, and so therefore the fact that the amount that the RBI can cut going forward is fairly limited. And I think our own belief is that we could probably get another maybe 50 basis points from here.
If you get a constructive budget and inflation stays at these levels, and the government can keep the deficit to about 5.3, that either in March or in April, another rate cut, a 25 basis point rate cut is likely.
Okay, straight to Dalal Street, and it was a very volatile day of trade, as pointed out. A great reaction to the monetary policy. We soared above 6,100, but by the end of the day, all of that euphoria absolutely tapered off. It was off by 0.5% for the frontliners. For the broader markets, they saw deeper cuts by the day's close. It was off by 0.5% for the mid-cap index. The small-cap index is where you saw the maximum damage, off by close to 1%. All of your sectoral indices, particularly the rate-sensitive sectors, ended deep in the red. So real estate was the biggest loser for today, shaving off 2%. Oil and gas followed suit once again. You had autos, but FMCG was the only sector which managed to hold up very marginally in the green. Some of the big index losers then for today, you had most of the banking stocks which rallied very smartly ahead of the policy, and even once the announcement was that came about, but by the end of the day they all sold off. So Bank of Baroda, HDFC Bank, apart from that Hindalco and Bajaj Auto as well. Some important results that were declared today. Sterlite Industries earnings came in below estimates this time around. The net sales came in at 10,692 crore rupees. That's versus 10,249 crores. You had the net profit coming in at 1,191 crore rupees. And remember, this includes a forex loss component of 259 crores. United Phosphorus put up a good set of numbers. The profits came in higher by 29% at 173 crores. The net sales higher by 20% at 2,255 crore rupees. EBITDA margins, they shrunk marginally, 17.9% versus 18.6%. Reliance Capital did put out a fairly okay set of numbers. The stock rallied but then tempered off by the day's close to end close to the lowest point of the day. You had the profits which came in at 101 crore rupees. That's up by 68%. The income from operations was higher by 10% at 1,712 crores. Century Textiles, disappointing set of numbers. It was a Q3 loss this time of 29 crores versus a profit of 54 crores, and the sales came in higher by 21% at 1,550 crore rupees. Some stocks in focus today. Take a look at the way Axis Bank panned out, absolutely bucking the trend in the banking arena. It leaped to a fresh 26-month high as the demand for its billion-dollar QIP was nearly thrice the number of shares that it offered. Intraday, it jumped as much as 6%. And remember, this news was reported exclusively on ET Now just yesterday. IVRCL, that counter was smashed as news reports indicated that NHAI said that work executed by the company has not been satisfactory. It is facing severe fund shortage. We spoke to the management who clarified that they have not missed any milestone deadline for ongoing projects, and NHAI has not expressed dissatisfaction at project execution. But that did not fail to alleviate the worries from investors. Adani Ports soared a good 7% on the stake sales in its Australian port, and that's seen as a big positive. You had Shriram EPC, in fact, which got orders worth 367 crore rupees, and on the back of that news, the counter rallied very smartly. Sri Renuka Sugars, Bajaj Hindustan, Balrampur Chini, some of the sugar stocks, they did rally very firmly, came off by the day's close as the government allowed the mills to sell unsold sugar in the open market. So on the back of that news, that's how the sugar stocks panned out. Moving on then, Amara Raja, it came out with its numbers yesterday post-market hours, a great set at that. 65.9 crore rupees, 80.9 crore rupees in terms of the bottom line growth. That's high by 22%. And the sales came in at 757 crores. Quite the contrary for Gujarat Alkalis though. Their net profits were down 28% and the net sales came in at 417 crores, down by close to 5%. Anji Vesya Bank, that put out a decent set of numbers. The profits came in at 162 crores, that's higher by 36%. NII was at 403 crores versus 324, and asset quality was stable. By the end of the day, the stock ended up in the green. Giving it company was an Axis Bank. Some of the big gainers for today included Jayaprakash Associates, Coal India and ITC2 rallied pretty smartly. But let's get into some market opinion on what the way forward is for the equity markets.
Certainly, our markets today are running based on FII flows. The domestic are a net seller. Now, if FIIs also become a net seller along with domestic, then could there be a correction sharper than 10%? Quite likely. But why will people do that if Indian markets are not very expensive? The corrections in the market will probably happen from that event or a factor which is not known yet.
Premised on this year, we think earnings growth would be roughly 12%. We've seen last year most of the returns came through re-rating. It didn't come through earnings growth. And we think this year the re-rating may be difficult, especially as we move into the later part of the year, because the focus of investors in the last quarter of this year will move to the 2014 elections and what shape the new government would take.
Look at valuations. Valuations are not stretched at all. So I do think that, the markets will tend to be, obviously I don't know about the next 2 days, but I think over the next 6 months, things should get better for Indian stocks, simply because I think we have obviously the risk on globally with the liquidity provision, and you also have the Indian government which is on an offensive in terms of announcing reforms.
Important to get in a view as to how the F&O activity shaped up for today. Navneet Saluja stands by from our research team. Navneet, 2 days ahead of expiry, and what a volatile day.
That's right, Van. It was quite a volatile session. Even if you look at the volumes, they were very high. If you look at the turnover on NSE, it was 2.6 crore for the F&O space. And actually, it was the expiry week which played a spoil sport today, because you saw a lot of profit booking in today's trading session. You saw the Nifty January futures reclaiming that 6100 mark in the intraday trade, but later slipped to close at about 60.50, almost flat to the spot Nifty as well. And if you look at the February futures, they are trading with a premium of about 40 points. They closed at 60.90, adding close to 24 lakh shares in open interest today, and the Nifty rollover currently stands at about 42%. The options data suggests that there was actually a lot of call writing in the system today. The Nifty PCR slipped to 1.03 versus the yesterday closing of about 1.12. Have a look at strikes, 6200, which added significant 43 lakh shares. Also 6100 call strike added 16 lakh shares, whereas on the put side you had 5900 put, which added close to 12 lakh shares, and the 6100 put shed about close to 7 lakh shares. And talking about the stock futures, well, only a few private banks were able to close in green today. So you had stocks like Axis Bank, Kotak Mahindra Bank and ICICI Bank where long positions were being built up. Alongside you had JP Associates and Coal India, which were the Nifty constituents which closed in the green territory. And from the short side you have Bank of Baroda and HDFC Bank, Hindalco, Tata Steel. All these counters witnessed short positions. From the mid-cap space you had Adani Ports, which did well, IVRCL, Infra, Opto Circuit, Century. All these counters were smashed, so fresh short positions were being built up. So all in all, it was a very, very volatile session where we closed about 23 points down.
Thanks very much, Navneet, for giving us that perspective, and very high volumes too, as she pointed out. But in terms of some other earnings today, mid-cap FMCG firm DABUR posted a profit of 211 crores. That's up 22% on a year-on-year basis. Net sales, meanwhile, stood at 1,631 crores, up 12%. The consumer care business that grew 12%, raking in 1,413 crores, while the food business revenue stood at 167 crore rupees. Let's hear out Sunil Duggal, the CEO of DABUR, on the highlights of the quarter gone by.
Pretty heartening under the circumstances that we are over the last many quarters able to maintain strong volume growth trajectory. There has been an element of inflation, so price increases have contributed to around 5%. Overall domestic business growth is 14.3, which is in line with what we did in the first couple of quarters. There's been a little bit of slowdown in some of the more discretionary items, so there could be a little bit of pressure on volumes, but I'm convinced that we should be able to grow volumes in the trajectory of 8 to 12%. Inflation hasn't been good to us in the current year, certainly not as good as what we thought, on the back of high commodity prices. The rupee-dollar impact, which has significantly eroded margins in our foods business, we hope that will be temporary. We should be able to regain the earlier margin profiles.
Cellular has put out its numbers. In terms of the net profit, 229 crore rupees. This is versus a figure of 240 crores and is against our poll of 252 crores. So on the bottom line front has been a bit below what the street was expecting. 5,570 crore rupees in terms of the revenue. This is as against an expectation of 5,523 crores. So on the top line front, it has been higher. Remember, there has been a forex loss in this quarter of 13.3 crore rupees. This is versus a gain of 18 crores in the second quarter. We were expecting a forex loss of close to 10 crores. Will be important to monitor some of the other details. In terms of the ARPUs, we're seeing it at 157 versus 148. The revenue per minute also is likely at 41.1 paise versus 41.3 paise. The reason why you're seeing a revenue growth lower this time, higher by just a marginal 3 or 4% this time around, is on account of the lower subscriber additions this time as well. In terms of the margins, we're expecting it at 27.1%, so fairly flat as against 26.8% last time around. Let's just quickly pull up the stock price of Idea Cellular, show you how it panned out ahead of its quarterly numbers today. These are all of the details that we have with us at hand, and on the face of it, the bottom line is a bit disappointing on account of the forex loss component. Well, it's spurted up by a good 1%. Have to wait and watch as to how Idea Cellular plans out come tomorrow morning. But moving on then to the aviation space, an ETIHAD Airways top team led by CEO James Hogan is arriving in India to seal the stake deal with Jet Airways. The 4-member team will meet the Aviation Minister Ajit Singh and Commerce Minister Anand Sharma to appraise them of the deal structure. Kartika Trehan now joins in from our Mumbai newsroom with the exclusive details. Kartika.
Well, absolutely. Etihad CEO James Hogan is likely to visit India, so we are expecting him to possibly be here on the 31st, and this entire team is likely to be led by James Hogan, but it will also include 3 board members, which could possibly be Mubarak Hamad Al-Muhari and Ahmad Abdullah Al-Shamsi, and also Khalifa Sultan of Suwaidi. So these are the 3 board members who are also likely to come along with him. On the other hand, they are likely to meet the Anand Sharma, the Commerce Minister, also the Aviation Minister Ajit Singh, and they are possibly going to discuss on the overall structure of the deal at this point. So we are picking up from our sources the deal has been finalized. So the final talks which are likely to take place, only discussing the share sale price and also discussing on the legal structure of the deal at this point. So while both the companies have refused to either confirm or deny the development, what you're picking up from our sources is that the deal structure and the share sale price could be anywhere close to about 750 to 760 rupees, which is nearly close to about 23% over in terms of premium of the current Jet's current market price. However, the deal structure is definitely going to benefit both Jet Airways and also Etihad Airways. Jet Airways at this point in time is looking at raising funds and also looking at global expansions, including expansion into markets like Europe and US. So this is definitely going to give them a hold into these 2 markets at this point.
Thanks very much, Kartika, for bringing us all of those exclusive details. So we'll have to wait and watch how that meeting pans out. But with that, we're completely timed out right here on Business Day. Thanks very much for watching. Keep it with ET now.